Okay, let's unpack this. Today, we're doing a deep dive that really gets to the core of corporate finance regulation.
Hmm.
We're focusing specifically on how companies raise funds, directly from members and the public through deposits.
Right.
And this isn't just theory, is it? These rules they're the bedrock.
They absolutely are. They're what safeguards investors and ensures corporate accountability when companies tap into public savings.
Exactly.
So our mission today is to take Chapter 5 of the Companies Act, which covers Section 73 to 76A, and really turn it into a masterclass for you.
So not just reading the law line by line.
No, not at all. We want to get to the why behind the rules. We'll use practical scenarios to show you what compliance looks like and, maybe more importantly, what the risks are if you get it wrong.
And we're keeping all the technical terms exactly as they are in the law.
We have to. But we'll wrap them in clear analysis so it all makes sense.
It's just essential knowledge for anyone in corporate funding or treasury, or even for someone thinking of investing in a company deposit. We're aiming to give you that well-informed shortcut, starting with the most fundamental question of all.
Which is,
Does the money a company just received even count as a deposit? Because that one question changes everything.
it determines your entire compliance burden. Let's start right there. The definition of deposit in the Act is designed to be a huge regulatory net.
It's meant to be broad on purpose.
Exactly. It includes any receipt of money by way of deposit or loan, or really in any other form. So you should think of it like this. If a company gets money, and it's not from selling shares, the law's default position is, that might be a deposit.
It's a way to catch all the creative financing methods companies come up with.
That's the idea.
But that seems incredibly sweeping. I mean, what if a company gets a huge loan from a major bank? Is that a regulated deposit? Or an advance payment for a big order?
And that is the absolute crux of the whole system. The initial definition is broad, yes, but the crucial part is what it excludes.
The famous exclusion lists.
The exclusion list.
Yeah.
The law doesn't want to regulate funds that are, already monitored by another regulator or funds that are just part of day-to-day business operations.
I see. So it's about avoiding regulatory overlap.
Right. This list was created in consultation with the Reserve Bank of India, the RBI, which tells you it's really about macroeconomic stability and protecting, unsophisticated retail savings.
And this list is where corporate finance teams either get it right or get it very, very wrong.
It's where they live or die, compliance-wise.
Okay. Before we dive into that list, let's quickly classify the money that does fall under the definition, because how you classify it dictates the disclosures, right?
Right. It's quite straightforward. You have two main types. First, you have secured deposits. These have to be fully secured by creating a charge on the company's tangible assets.
Tangible assets. So not things like goodwill or trademarks.
Exactly. And second, you have unsecured deposits, where there's either partial security or no security at all. The whole point is transparency about the risk.
And the law is absolutely uncompromising on this point, especially with partial security. Let's use an example. Say Varsha Ltd raises 20 lakh rupees, but they only secure it with assets worth 15 lakh.
Mm-hmm.
You'd think it's a partially secured deposit, but that's not how the rules see it, is it?
Not at all. In that scenario, the entire 20 lakh is classified as an unsecured deposit.
The whole thing.
The whole thing. The logic is, if you promise security to the public, the law demands 100% coverage. If you can't meet that, you're forced to use the riskier classification.
And you have to state that explicitly in every single document.
Every circular, every advertisement.
Yeah.
It forces companies to be honest about the level of protection they're offering.
So now we know what money is regulated. Next, we have to ask who the money is coming from. This really changes the compliance burden.
Massively. The law puts depositors into two main buckets. First, you have any member of the company, a shareholder in a private or public company who deposits money under Section 73.
So that's internal funding.
Right. It's from people who are already connected to the company, so the compliance is a bit lighter.
And the second category.
The second category is any person, which means the general public, non-members, anyone.
Okay.
And they can only deposit money with what's called an eligible public company under Section 76.
And the moment you start taking money from the public, the rules get much, much tougher.
Exponentially tougher.
That brings us perfectly to the definition of an eligible company. This is basically the license you need to access public funds.
And it's reserved for big established companies for a reason. The bar is set very high.
So what are the thresholds?
An eligible company has to be a public company, of course. And then it needs to meet one of two financial criteria. It must have either a net worth of at least 100 crore rupees or a turnover of at least 500 crore rupees.
So you need significant financial muscle.
You do. Hitting those numbers is the gateway to tapping public savings.
And you can't just decide to do it. You need shareholder buy-in first.
Absolutely. The company must get prior consent through a special resolution at a general meeting.
A special resolution, that's a 75% majority, right?
It is. It's a high bar, and it shows that the company's owners are fully on board with taking on this huge public liability.
And that resolution has to be filed with the Registrar of Companies before you even start the invitation process.
Correct. The regulator needs to know before you go to the public.
There is a little bit of flexibility, though, isn't there, if the borrowing is within existing limits?
There is. If the company is accepting deposits that are within the overall borrowing limits that shareholders have already approved under Section 180.
The general power to borrow.
Exactly. In that case, an ordinary resolution, a simple majority, is enough. It's just a common sense efficiency measure.
Okay, let's tackle the biggest conceptual hurdle, that exclusion list. Let's try to categorize these exceptions to understand the logic instead of just reading a list.
That's a great approach. We can group them by the regulatory philosophy behind them.
Let's start with the first bucket, sovereign, international, and regulated institution funding. This seems to cover funds that are already being watched closely by someone else.
That's precisely the logic. This includes any money from central or state governments or from foreign governments, international banks like the Asian Development Bank, and so on.
And also loans from the big Indian financial players.
Yes, loans from banking companies, SBI, public financial institutions, insurance companies, all the heavyweights.
So if a company gets a term loan of 10 lakh rupees from, say, Beta Bank, that's governed by banking regulations, not these deposit rules.
Exactly. The risk is managed at the source by the banking regulator. It prevents compliance clutter.
But I assume if the money is from a foreign source, other rules still apply.
Oh, absolutely. Even if it's excluded from the deposit rules, it's still fully subject to the Foreign Exchange Management Act, or FEMA. There's no regulatory free pass. The oversight just shifts.
Makes sense. Okay, bucket number 2, market instruments and sophisticated corporate funding. This sounds like transactions between parties who are expected to know what they're doing.
It is. This is where you see the exclusion for intercompany deposits, or ICDs. Money from another company is considered a transaction between sophisticated parties.
And what about capital market instruments?
Commercial paper is excluded, and so are specific types of non-convertible debentures, NCDs.
But there's a very important condition for NCDs, isn't there? Because they can look a lot like a corporate deposit.
A critical one. They are only exempt if they meet 2 strict conditions. First, they cannot constitute a charge on the company's assets, and second, they must be listed on a recognized stock exchange.
So the stock exchange listing provides the transparency that a charge on assets would otherwise provide.
Exactly. The public disclosure and market mechanism required by SEBI acts as the regulatory safety switch. If an NCD isn't listed, it falls right back into the deposit category unless another exemption applies.
Okay, now for the third, and I think the most dangerous bucket for most companies, operational and temporary funding tripwires.
These are the ones that keep compliance managers up at night. Common, everyday transactions that can suddenly flip classification if you miss a deadline.
Let's start with share application money.
Right. A company gets money from investors before it can allot shares. The law understands this, but it puts a very tight leash on it.
What are the key dates here? The 2 deadlines everyone needs to know.
You have 60 days from receiving the money to actually allot the securities.
60 days. And if you can't.
If you can't, you then have another 15 days to refund the money in full.
So that's a 75-day window in total. A hard stop.
A very hard stop. If you fail to refund the money within that 75-day period, the entire amount is automatically treated as a deposit.
And you can't just, say, adjust it against a future purchase.
No. The law is explicit. An adjustment is not a refund. The cash has to go back to the investor.
This stops companies from using failed IPO money as a kind of backdoor loan.
Precisely. Now let's talk about the director funding exclusion.
This one is very common.
Very. Money from a director, or a relative of a director in a private company, is excluded. But there's a huge catch. The required declaration.
What does that mean?
The director, or the relative, has to give the company a written declaration stating that the funds they are providing were not themselves borrowed or accepted as loans or deposits from others.
Ah, so the law is preventing the director from just being a middleman for other people's money.
Exactly. The source of the funds has to be the director's own unborrowed money.
It's about maintaining the integrity of the source.
It is. And the company has to disclose these details in the board's report to maintain transparency.
Okay, what about bonds and debentures that are secured?
If the instrument is properly secured with a first charge on tangible assets, or if it's compulsorily convertible into shares within 10 years, it's exempt.
And there's a valuation rule here too, I imagine.
Of course. The security valuation rule. The amount you raise can't be more than the market value of the assets you're charging. And that value has to be assessed by a registered valuer. No funny business with asset values.
Now for a classic operational trap, employee security deposits.
This is such a common transaction, but it can become a compliance nightmare in an instant.
So a non-interest-bearing security deposit from an employee is normally exempt.
It is, but only up to a certain limit, and that limit is the employee's annual salary.
And that ceiling is absolute.
Absolutely.
Absolutely. Let's use the Ratnakar example to show how serious this is. His annual salary is 6 lakh rupees. He deposits 6 lakh and 50,000. Does the extra 50,000 become a deposit, or does something worse happen?
Something much worse happens. The moment the amount exceeds the annual salary, the entire 6,050,000 is treated as a deposit.
The whole amount, not just the excess.
The entire amount. That one small error of 50,000 rupees creates a massive compliance failure for the whole transaction. The company now has to apply all the deposit rules to that money.
Wow. Okay, next up is the big one, business advances.
Right. The law acknowledges that companies need advances for trade. Advances for supplying goods or services are exempt, but only if they're used up or appropriated within 365 days.
So there's a time limit on those too.
A 1-year limit. It's to separate legitimate trade financing from what could become long-term public borrowing.
But what if the deal falls through and the advance has to be refunded?
That's where the crucial refund rule kicks in. If an advance becomes refundable, maybe because the company couldn't get the right permissions, it is deemed to be a deposit if it's not refunded within 15 days of becoming due for refund.
Another tight deadline.
A very tight one. Hold on to the money for 16 days and you've just accepted a regulated deposit without following any of the rules.
Finally, there's a very specific, very modern carve-out for startups.
Yes, for convertible notes. For a recognized startup company, an amount of 25 lakh rupees or more received in a single tranche as a convertible note is excluded.
The details there are so specific, 25 lakh or more, single tranche.
And that's where companies get caught. The Greenwood Ltd example is perfect. They raised 30 lakh in total, which is over the threshold, but they received it in 2 parts, 20 lakh and then 10 lakh on different dates. It was not in a single tranche.
So it's not exempt.
It is not exempt. The entire 30 lakh becomes a deposit. You fail one part of the condition, you fail the entire exclusion.
The main takeaway from this whole section is that the law starts by regulating everything, then carves out these very specific exceptions.
Right.
But if you miss a single condition, whether it's a deadline, a limit, or a procedural step, the transaction snaps right back into that highly regulated deposit category.
That's the perfect summary. The exceptions are a privilege, not a right, and they come with very sharp edges.
So now we know what a deposit is. Let's move to Section 73, which sets the general prohibition.
Section 73(1) is the starting gun. It says, no company can accept or renew deposits from the public unless it follows all the rules we're about to discuss.
But there are some major players who are just completely exempt from this. I'm thinking of banks, NBFCs. Why is that? Isn't that a huge accountability gap?
It's not a gap. It's actually about jurisdictional efficiency. The rules in Section 73 do not apply to banking companies, non-banking financial companies, or housing finance companies.
Why not?
Because these entities are already intensely regulated by their own sectoral watchdogs, like the RBI or the National Housing Bank. Their rules on liquidity, capital adequacy, and disclosure are often even stricter than what's in the Companies Act. The law simply avoids regulating the same thing twice.
Okay, that makes sense. So if you're a regular non-exempt company and you only want to raise funds from your existing members, Section 732 kicks in.
Yes, this is the first level of compliance, and it's built on shareholder consent and full disclosure.
The first step is a resolution in a general meeting. What's next?
The most demanding step is issuing a circular using Form DPT-1. This is basically the prospectus for the deposit, and it goes to all members.
And there's a non-negotiable document that must be attached to that circular, right?
There is. A certificate from the company's statutory auditor. And this certificate has to confirm one of 2 things. Either the company has a clean record with no defaults on previous deposits, or
if there was a default.
If a default did happen, it must have been made good, and a full 5 years must have passed since it was fixed.
5 years. That's a long time in the penalty box.
It's a very serious penalty for any past failure. It enforces long-term accountability.
And this circular isn't valid forever, is it?
No, it has to be renewed annually. Its validity is tied to the company's most recent financial performance. It expires on the date of the next AGM or 6 months from the end of the financial year, whichever comes first.
So members are always making decisions based on fresh, audited numbers.
That's the goal.
And before the circular even gets to the members, it has to go to the regulator.
Yes, a copy must be filed with the ROC at least 30 days before it's issued. This gives the regulator a window for scrutiny.
Now let's talk about the real safeguard here, the mandatory liquidity buffer, the deposit repayment reserve account, or DRRA.
This is the core structural protection in the whole chapter. It's a powerful mechanism. On or before April 30th each year, the company must deposit at least 20% of the amount of its deposits that are maturing in the following financial year into a separate bank account.
So it's forcing them to save for future repayments.
Exactly. It proactively builds a reserve to ensure they have the cash when the deposits come due.
And the regulatory firewall around this DRRA account is absolute, isn't it?
It is. Section 73.5 is crystal clear. This money cannot be used for any purpose other than repaying deposits.
So even if the company is facing a major cash crunch,
Even then, they can't divert the DRRA funds to pay other creditors or cover operating expenses. That money is strictly legally ring-fenced for the depositors.
Okay, what about the actual terms of these deposits? Are there rules on how long they can be for?
Yes, the 10-year rules are designed to stop corporate deposits from acting like bank savings accounts.
So no on-demand repayment.
Definitely not. The standard 10-year has a minimum of 6 months and a maximum of 36 months.
3 years.
Right. It has to be a fixed-term investment.
But businesses do have short-term needs. Is there any way to accept a deposit for, say, 4 months?
There is. There's a short-term exception for that exact purpose.
Mm.
A company can accept deposits for less than 6 months, but there are 2 strict conditions.
Okay.
First, the total amount of these short-term deposits can't exceed 10% of the company's paid-up share capital, free reserves, and securities premium. So it's a small amount.
And the second condition?
The 10-year can't be for less than 3 months. This prevents them from becoming true demand deposits.
So there's a tight leash on that exception. And what about the overall maximum amount a company can raise from its members?
The general rule is that the total amount of deposits from members cannot exceed 35% of the aggregate of its paid-up capital, free reserves, and securities premium.
Ah.
That's the ceiling for most companies.
Now, this is where the law gives certain types of companies a major break. Some private companies are exempt from all the heavy procedural stuff.
They are. The rules about issuing a circular, the DRRA, the auditor's certificate, none of that applies to certain private companies.
Why the free pass?
Because the risk is seen as being contained within a small, informed group of members. So this procedural relief is granted to 3 types of private companies.
What's the first one?
A small private company that accepts money from its members up to 100% of its paid-up capital and free reserves.
So they can accept almost 3 times the standard limit without the procedural hassle.
Right. The second is a startup private company, which gets a 5-year holiday from these rules after incorporation.
And the third one is the most complex, the qualifying private company. It has to pass a triple test.
It does. This is the most rewarding exemption, but you have to prove you are a genuinely small, independent, and financially disciplined company.
So let's break down that triple test. What's the first condition?
First, it must not be an associate or a subsidiary of any other company. It has to be truly standalone.
Okay, what's second?
Second, its total borrowings from banks and financial institutions must be less than twice its paid-up share capital, or R50 crore rupees, whichever is lower. It's a hard cap on its leverage.
And the third part of the test?
It must have no defaults in repaying any of its existing borrowings. Clean financial conduct is mandatory.
And if a private company clears all 3 parts of that test?
Then the standard 35% limit on deposits from members just doesn't apply to them. They have significantly more flexibility to raise funds from their members.
So with all these exemptions, is there still any kind of filing requirement? Does the regulator still need to know what's going on?
Oh, absolutely. This is key. Regardless of which exemption they use, all of these private companies must still file the details of the money they've accepted in Form DPT-3.
So the regulator waives the procedure but maintains total visibility?
Exactly. No transaction is completely off the regulator's radar.
This is where things get really interesting. When a company becomes eligible and can access money from the general public,
Yes. The moment you step outside the circle of members and invite the public, the regulatory burden becomes immense. The entire focus shifts to protecting unsophisticated investors.
we know they need a special resolution. What's the biggest new requirement that kicks in for public deposits?
The mandatory credit rating. This is non-negotiable.
Because the public can't do their own deep financial analysis.
Precisely. The company must get a rating from a recognized credit rating agency that covers its net worth, liquidity, and its ability to repay on time.
And is there a minimum standard for that rating?
Yes. The rating cannot be below the minimum investment grade.
Yeah.
And you can't just get it once and forget about it.
It has to be updated.
It has to be obtained and reported every single year for the entire tenure of the deposits. It's about providing continuous, updated risk information to the public.
And what if the company is offering secured deposits to the public? The rules get even more specific.
They do. The security must be created by a charge on the company's tangible assets only.
Again, no intangibles like goodwill.
Correct. The value must be assessed by a registered valuer, and it must cover the principal plus all the interest payable.
And this security isn't held by the company itself.
No, it's held by an independent watchdog, the trustee for depositors.
The appointment of a trustee is mandatory for secured deposits.
It is, and the law goes to great lengths to ensure this trustee is truly independent and has no conflicts of interest.
What are some of the key disqualifications?
Well, a person can't be a trustee if they are a director, an employee, or even a depositor in the company or its subsidiaries. They can't be indebted to the company or have any kind of significant financial relationship.
So the trustee's only loyalty is to the depositors.
That's the entire point. They act as the depositor's representative, especially if things go wrong.
Yeah.
They can even call a meeting of all depositors if there's a default.
And when you invite the public, you can't just send a simple circular. It has to be a public advertisement.
That's right. And it has to be published widely, in English, in an English newspaper, and in the local vernacular language, in a vernacular newspaper, plus on the company's website.
It's all about maximum reach and accessibility.
It is. And just like with the member circular, a copy has to be filed with the ROC 30 days before it's published. That 30-day window is a consistent procedural requirement.
And just to confirm, do the same tenure and interest rate limits apply here?
Yes, exactly the same. A minimum of 6 months, a maximum of 36. And the interest rate they offer cannot exceed the maximum rates prescribed by the RBI for MBFCs.
So you can't offer crazy, unrealistic returns to lure the public.
The law prevents that to maintain financial stability.
Okay, so once the deposits are in, the company has a whole set of administrative rules to follow. It starts with the application form itself.
It does. The depositor has to sign a declaration on the form saying that the money they are depositing is not borrowed from someone else.
This is the third time we've seen that concept, with directors, their relatives, and now the general public.
It underscores that key regulatory goal, to stop unregulated money from flowing into a company through a proxy.
And what about joint accounts? How many people can hold a deposit together?
The limit is 3. No more than 3 joint depositors. And the company has to be very clear about the repayment terms, like either or survivor, to avoid confusion at maturity.
Once the company receives the money, how quickly do they need to provide proof of the transaction?
They must issue a formal deposit receipt within 21 days. That rapid timeline is a strict compliance point.
And all of this information has to be meticulously recorded in a register of deposits. How long do they have to keep those records?
They have to preserve that register for not less than 8 years from the financial year of the last entry.
8 years. That ensures long-term regulatory traceability.
It does. And finally, the terms you offer are the terms you have to stick with. A company can't change the agreement later on if it's disadvantageous to the depositors.
Let's talk about what happens when depositors want their money back early.
Well, premature repayment is allowed, but only after 6 months have passed.
And there's a penalty.
Yes.
Huh.
The interest rate is reduced by 1%. It's a disincentive to break the fixed term.
But if the company is the one who defaults and doesn't pay back on the maturity date, the penalty is much more severe.
Oh, much more. If the company fails to repay a deposit on time after it's been claimed, it has to pay a penal interest rate of 18% per annum for the entire overdue period.
18%. That's a huge stick to ensure timely repayment.
It's designed to be. It heavily compensates the depositor for the company's breach of trust.
And we've mentioned Form DBT3 a few times. This is the big annual filing that ties everything together.
It is. Every year, by June 30th, a company has to file this audited return.
And its scope is very broad.
Very. It's not just for reporting actual deposits. You also have to use it to report all those transactions that are not considered deposits, the entire exclusion list.
So the regulator gets a full picture of all the company's debt, making sure nothing has been misclassified.
Exactly. It applies to every single company except government companies. It's the ultimate annual check-in.
We've laid out the entire roadmap, but the system is only as strong as its punishments for non-compliance. And Section 76A is where the law shows its teeth.
This is not just an administrative fine. The punishments here are punitive, and they target both the company and the individuals responsible.
Let's start with the fine on the company. How is it calculated?
The fine starts at a minimum of 1 crore rupees, or twice the amount of the deposit, whichever is lower.
And there's a ceiling.
Yes, the fine can extend up to a maximum of 10 crore rupees.
So even for a relatively small default, the minimum fine is a painful 1 crore.
It is. The structure is designed to be a serious deterrent.
And for the individuals, the officers in default, they face the risk of jail time.
They do. The officer in default can be punished with imprisonment for up to 7 years.
7 years. And a massive personal fine on top of that.
Yes, a fine of not less than 25 lakh rupees, which can extend up to 2 crore.
So there is absolutely no hiding behind the corporate veil. Personal accountability is built in.
It is. And there's one more layer. If the officer acted willfully, with the intent to deceive anyone,
Then it's not just a violation, it's fraud.
then it becomes a case for action under Section 447, the punishment for fraud, which is the most severe level of criminal prosecution under the Act.
And what about old deposits? From before this act came into force, the law had a plan for those too.
It did. Section 74 dealt with those legacy deposits. Companies had to report them and repay them under a specific timeline. The tribunal could grant extensions, but if they still failed to pay,
The penalties were just as severe.
exactly the same. A minimum 1 crore fine for the company and up to 7 years in prison for the officers. The message is consistent. A debt to a depositor must be honored.
Given all this complexity, the thresholds, the 18 exceptions, the different rules for members, and the public disputes about classification must happen, who gets the final say?
If there's any question about whether these rules apply to a specific company or a specific transaction, the final decision is made by the central government in consultation with the Reserve Bank of India.
So the ultimate interpretation brings together both corporate law and central banking perspectives.
It ensures the final decision considers both legal compliance and overall financial stability. When you step back and look at it, what really stands out is this incredibly detailed legal architecture, all designed to protect the retail depositor. The law forces companies to prove their independence through trustee disqualifications, to maintain solvency through that DRA firewall, and to be continuously transparent through annual credit ratings. It's so comprehensive.
It really is, and it's a profound lesson in how what looks like boring administrative compliance, hitting deadlines, filing forms, is actually the core financial safeguard. Whether you're a director trying to stay within the 36-month tenure limit or a private company trying to clear that triple test to get more flexibility, these granular details are everything. And the sheer severity of the penalties in Section 76A shows you that getting this wrong is seen as, at best, gross negligence, and at worst, outright fraud.
Indeed. The entire system really pivots on those timelines, the 75-day tripwire for share application money, that 30-day filing rule for circulars, and the April 30th deadline for the DRA contribution.
Yes.
These aren't just minor administrative points. They are the essential tripwires designed to manage risk before it ever becomes a crisis.
So, what this all means is, the next time you see a company inviting deposits, you now have the tools to understand the exact level of regulatory scrutiny they are under. You know where the legal lines are drawn between a normal business advance and a highly regulated public debt. And that brings us to our final provocative thought for you to explore. Considering those extensive exemptions that banking companies and NBFCs get, what are the long-term implications as other companies look for new ways to get capital? Are they creating ever more complex financial instruments, things that are designed to look and feel like a deposit, but are structured to deliberately skirt the edges of the technical definition just to avoid the huge compliance burdens we've discussed today?